Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
This week, we've got quite a lot to get through, actually. We're going to dig into the accelerating shift to T+1 settlement for securities, and also the, well, frankly, massive financial implications of this looming car finance compensation scheme, plus some urgent scam warnings linked to that.
Yeah, definitely need to cover those. We'll also unpack the sort of evolving landscape of consumer credit, some reforms coming down the track for the appointed representatives regime.
Right.
We'll look at how the market for sustainability-linked loans is maturing, maybe hitting some bumps, and flag up a real surge in whistleblowing reports recently. And then we'll round off with the latest UK economic snapshot.
Okay, so quite a mix. And look, these aren't just, abstract headlines. For you, working in UK retail banking, these changes represent pretty fundamental shifts.
Absolutely. We're talking market infrastructure, potentially huge financial liabilities, your duties around consumer protection are evolving, plus those crucial economic indicators.
Exactly. All stuff that directly hits your strategic planning, your risk management, and of course your compliance frameworks.
Yeah.
So let's get right into it.
Okay.
First up, T+1 settlement. The race to October 2027. So the UK market is definitely committed now, moving to T+1 settlement for securities trades. Target date, 11 October 2027. Beyond just making things faster, what's the sort of core strategic reason for this big push?
Well, efficiency is definitely part of it, Alex, but the bigger picture is really about bolstering the overall resilience and, the competitiveness of UK markets.
Right.
Faster settlement, it reduces counterparty risk, it frees up liquidity, and crucially, it keeps the UK aligned with other major global financial centers.
Okay.
The Accelerated Settlement Taskforce, the AST, chaired by Andrew Douglas, they've really mapped this out, and they've got strong backing from the FCA, government, and the Bank of England.
And the FCA seems quite clear on what they expect from firms. They use that phrase, engage with the recommendations of the AST. What does that engagement actually mean in practice for a bank?
Yeah, and engage isn't just, reading the report. It means actively assessing your operational readiness.
Wow.
So we're talking about setting budget aside, figuring out the system changes needed, doing proper testing, maybe new agreements with third-party providers,
Right.
and definitely reviewing all your counterparty arrangements.
Yeah.
The FCA has also said it will be monitoring how prepared firms are, either directly or maybe through trade associations. So expect that scrutiny.
Okay, now there's a really important distinction here, isn't there? Securities move to T+1, but what about investment funds? Is it the same path?
You've hit on a key point. No, it's slightly different.
Yeah.
While securities are targeting T+1, the main asset management trade bodies have actually recommended funds move to T+2.
T+2.
2 business days after trade date. Also from that same date, 11 October 2027. And the FCA supports this. They think it's better for investors, especially for UK-authorized funds and recognized schemes that invest heavily in those T+1 markets. It sort of acknowledges the different operational needs for fund settlement.
And how does this position the UK internationally? Are we leading, following?
Well, the US, Canada, Mexico, Argentina, they already jumped in May 2024.
Right.
The EU and Switzerland are also looking likely for October 2027 for T+1, though the EU mentioned a possible exemption for some securities financing deals. But yeah, the overall trend is clear. Faster settlement is becoming the global standard.
So the takeaway for your institution listening is, this isn't just some back office tech upgrade. It's fundamental. It impacts trade processing, liquidity, risk. And maybe the real pinch point isn't just your own systems, but your counterparties. Are you actually checking now that your key third parties, your main trading partners, are they on track for 2027 too? That coordinated effort is where the real risk, or maybe the advantage, lies.
Spot on. That interconnectedness is crucial.
Okay, let's shift gears. Car finance. Billions potentially at stake, and these urgent scam warnings. This feels like it could be huge.
It really could, Alex. The FCA is consulting now on a potential compensation scheme. This all stems from that Supreme Court ruling about historic commission arrangement.
The discretionary commissions, right?
Exactly. Where lenders paid car dealers and sometimes paid higher commission if the customer took out a loan with a higher interest rate. A practice the FCA banned back in 2021 because, well, it could harm consumers. So that ruling opened the door for claims about overly large commission fees, and the FCA's own review found pretty widespread misconduct.
And the numbers being talked about are staggering.
Okay.
An estimated total bill for lenders, big banks, specialist finance firms, maybe as much as $18 billion.
Yeah, the overall potential liability is enormous. Though for individual consumers, the FCA expects most people eligible would get less than, say, £950. The consultation is running for about 6 weeks. If the scheme gets the green light, payments could start next year, and potentially millions could be eligible, maybe going back as far as 2007.
Right. Now, whenever there's talk of compensation payouts, well, it's almost inevitable, isn't it? The scammers pile in.
Sadly, yes.
The FCA's put out an urgent warning. Fraudsters pretending to be car finance lenders, saying people are owed money, asking for bank details, personal info. What's the absolute key message for customers right now?
That's crucial. Nisha Arora at the FCA, she's the director of special projects, she put it very bluntly. There is no compensation scheme in place yet. If anyone receives a call like this, hang up immediately and do not share any information.
Just hang up. Don't engage.
Exactly. The message is be vigilant. If it sounds too good to be true, well, it almost certainly is.
And the FCA is very clear. They will never ask for bank PNs or passwords. Good practical tip, too. Report scam calls to Ofcom. Just forward the message or details to 7726. They've also warned quite strongly against using claims management companies, CMCs, or even law firms for this. Why?
Well, simply because they could charge a lot, maybe up to 30% of any money someone gets back.
Wow.
The whole idea of a central scheme, if it happens, is to make it easy for people to claim directly without needing these middlemen taking such a big cut.
So, for you listening in retail banking, it's really a double challenge, isn't it? On one hand, managing this potentially massive financial liability. On the other, actively protecting your customers from these scams. And thinking beyond just the immediate cost, what about brand reputation? How will your firm handle communications around this? Could it be an opportunity even to show you're genuinely committed to fairness, not just ticking a compliance box? Vigilance is key for your teams.
Absolutely. Proactive communication and clear guidance will be essential.
Okay, let's look at consumer credit more broadly now, and also the appointed representatives regime reforms.
Yeah, and the potential scale of the car finance issue really underscores that intense FCA focus on consumer protection. It ties into the whole picture of consumer credit. Alex, what's the latest from the FCA's Financial Life Survey telling us?
Well, it shows just how central credit is.
Yeah.
84% of UK adults, that's nearly 46 million people, held at least one credit or loan product in the last year. It's embedded in daily life.
And for quite a few, it seems credit has become more than just convenient. It's a lifeline, really. You've got 5% with persistent credit card debt and significantly 10% using personal loans for absolute essentials like food or rent.
Yeah, that 10% figure is striking. It really shows the pressure some households are under. And the FCA has drawn some lessons from all this. Firstly, that credit isn't automatically the right solution. Sometimes better money management advice or help accessing benefits is more appropriate. That ties right into the consumer duty, doesn't it?
It does, yeah.
Secondly, they see technology as a powerful tool for spotting early signs of financial difficulty, allowing firms to step in sooner.
Proactive support.
Exactly. And thirdly, they're really pushing collaboration. Banks, fintechs, community lenders working together.
Right.
They mentioned examples like Moneyline and Invest.ai's toolkit that helps signpost people declined for credit towards other support.
And looking forward. Alison Walters, the Director of Consumer Finance at the FCA, she outlined their priorities for the next decade. Firstly, innovation that actually adds real value for consumers.
Right. Not just tech for tech's sake.
Precisely. Secondly, compassionate support for vulnerable customers. She called that non-negotiable. How firms handle hardship is critical. And thirdly, ensuring credit is both accessible and suitable. It's that balancing act between access and protection. The FCA is quite active in the government's Financial Inclusion Committee on this.
Okay. And in a sort of related area of oversight, HM Treasury has signaled reforms are coming to the appointed representatives or AR regime.
That's right. It's a bit of a balancing act for the government here, too. They want to keep the benefits of the AR regime, helping firms innovate and access markets without needing full authorization right away. But they also have to tackle these growing concerns about poor oversight by the principal firms, which can put consumers at risk.
So how do you keep the flexibility but tighten the controls?
Exactly. The plan is for targeted, proportionate legislative reforms. They'll consult on those specifics soon. The aim is to boost confidence and ultimately protect consumers better.
So for retail banks, especially those providing credit, making sure your products genuinely fit customer needs, particularly vulnerable customers, that's absolutely central now under consumer duty. And if your bank acts as a principal firm for ARs, well, these reforms are definitely going to mean stricter oversight and more rigorous due diligence is required from you.
No question. The expectations on principals are rising.
Okay, let's turn to sustainable finance and also whistleblowing. Integrity and oversight seem to be the common threads here.
They are. And consumer protection, strong oversight, these themes run right through the FCA's agenda. It applies just as much to newer areas like sustainable finance, and as we're seeing, issues are increasingly being flagged internally. So, sustainability-linked loans, SLLs, what's the latest there, Jamie?
Well, the FCA sees these as strategically important for funding the net zero transition.
Yeah.
They keep citing that figure the UK needs an extra 50-60 billion a year in capital investment to hit the 2050 target. SLLs are meant to be a key tool for that.
Right. And there has been progress. Remember the FCA's 2023 review. It flagged up weaknesses, market integrity, credibility issues, incentives, conflicts of interest. But since then, things seem to have improved somewhat. The key performance indicators, the KPIs, and the sustainability performance targets, SPTs, they seem to be getting, well, more relevant now, more aligned to the borrower's actual business, usually focusing on just 2 or 3 core strategic targets.
Okay, more focused.
Yeah. And in syndicated loans, having multiple sustainability coordinators seems to be leading to better scrutiny and perhaps more ambitious targets being set.
And crucially,
Crucially, banks are actually showing they're willing to use declassification, basically stripping the sustainable label if borrowers breach the terms. The FCA sees that as a sign that standards have been raised. They also give a nod to industry standards like the LMA's SLLPs and FMSB's Statement of Good Practice for helping lift that baseline.
Okay, so some positive signs.
Yeah.
But are there still concerns?
Oh, yes. Sasha Sadan, the FCA's Director of Sustainable Finance, he's flagged several ongoing issues. One is a lack of clarity, still, in how banks actually account for SLLs within their own sustainable financing targets. That ambiguity can create reputational risks. Banks need clearer frameworks. They also need to stay alert to potential conflicts of interest, particularly in syndicated deals. And a big one. Borrower incentives often remain quite low. The cost savings are marginal compared to the high reporting costs, especially hitting SMEs hard.
Right, the cost burden.
Yeah. Interestingly, though, Sedan suggested that seeing more missed targets might not necessarily be a failure. It could actually mean the market's maturing, and the SLLs are doing their job by locking borrowers into genuinely ambitious targets.
Okay, so a miss isn't always bad if the target was tough to begin with.
Potentially, yes. But those barriers for SMEs reporting costs, getting external assurance, they definitely persist.
So the FCA is continuing work with the Transition Finance Council, encouraging banks to collaborate more on transition finance approaches. Now, shifting slightly, but sticking with integrity and oversight, we've seen a really noticeable jump in whistleblowing reports, haven't we?
We have a significant increase. The FCA got 315 new whistleblowing reports just between April and June this year, Q2 2025. That's up from 253 in the same period last year. So the question is, what are people actually reporting?
And those 315 reports contained over 1,100 separate allegations. Compliance was the top category, followed by fitness and propriety, organizational culture, but significantly, 98 allegations were specifically about the consumer duty.
Wow, nearly 100 just on consumer duty. That really shows it's biting, doesn't it? It's clearly focusing minds internally on conduct.
Absolutely. And this isn't abstract. In the last financial year, retail lending, retail banking, and retail investments were consistently in the top 3 sectors for whistleblowing cases being opened. It's right there on the front line.
And the FCA is acting on these. They closed 350 reports in the quarter, taking significant action in 8 cases and action to reduce harm in 147 others.
So the message for banks is clear. If you're involved in green finance, the integrity of your SLLs is vital. And this surge in whistleblowing, especially around consumer duty, means scrutiny of conduct is intense and ongoing. You absolutely need robust internal channels for people to raise concerns and processes to deal with them effectively and proactively.
Definitely. Ignoring internal warnings is just not an option.
Okay, finally, let's zoom out a bit and look at the UK economic snapshot. We've just had the Q2 GDP figures for 2025. What's the headline number, Jamie?
The UK economy grew by 0.3% in the second quarter, so April to June.
0.3%.
Now, interestingly, while that is a slowdown from the 0.7% growth we saw in Q1, it actually beat the city forecasts. They were only expecting about 0.1%. And monthly GDP in June was also stronger than predicted, up 0.4%.
So a bit better than feared, perhaps.
In headline terms, yes. Year-on-year growth was positive, too, at 1.2%. And GDP per head, a measure closer to living standards, grew 0.2% in Q2, up 0.7% year-on-year. But it has to be said that's still weaker than historical averages. It reflects those ongoing challenges for household finances.
Right. So what was actually driving the growth that we did see and what was holding things back?
Well, some factors pulling growth down included higher costs for businesses, things like increased national insurance, higher minimum wages, also general caution from consumers. And apparently some activity got pulled forward into earlier months because people expected changes in things like stamp duty or maybe U.S. tariffs.
Okay. And the positives.
On the plus side, the services sector was the main engine, up 0.4%. Particularly strong were information and communication and health and social work. Construction also had a good quarter, growing 1.2%.
But not everything was growing.
No. The production sector actually fell by 0.3%. And quite worryingly, perhaps, business investment was estimated to have dropped by 4.0% in the quarter.
4% drop in business investment. Ouch.
Yeah, that's a significant fall. Government spending, particularly on health and defense, made a pretty big contribution to the overall GDP figure, though.
And how did the politicians react to these mixed numbers?
Well, Chancellor Rachel Reeves called the figures positive, but immediately added there is more to do to deliver an economy that works for working people. She mentioned priorities like infrastructure investment, cutting red tape. The shadow chancellor, Mel Stride, took a different tack, criticizing the government for, in his words, taxing the living daylights out of businesses. So the usual political debate about the best path for growth continues.
Okay, so for your institution listening, yes, the headline GDP was a bit better than expected, which is welcome, but that weaker growth in GDP per head, that has direct implications for household budgets, potentially credit risk, and that fall in business investment, that clearly affects loan demand and your broader strategic thinking. It's a pretty complex picture still.
It is, and maybe something to mull over is how all these different threads we've discussed, the regulatory shifts like T+1, the car finance liabilities, the evolving consumer duty, the push for sustainable finance, how will their interplay shape the UK's economic resilience and the financial sector's direction over the next year or so?
That's a good thought to end on. Right, that's all from us this week. Thanks for listening to Reg Talk UK. Until next time, stay sharp and stay compliant.